Hello, welcome to the debrief for our tax mock exam. So the mock exam was the specimen exam for the Finance Act 2025, and starting with question number 31. So I'm going to go through the section C questions. Okay, the first question in section C. The first questions in the tax exam in section C, the 10 markers are usually around a tax planning area. Okay, we know that one question will definitely be on the income tax computation, one question will be on a corporation tax computation, the 15 mark ones. The 10 mark questions are usually on a planning area from any parts of your syllabus. So we have the question, we have the case here of Sarah. Part A is asking us to determine whether or not there will be an overall saving of tax and NIC for the year ended April 2026 if Sarah incorporates her business on 6th April 2025. So if at the start of the tax year, she incorporates her business, incorporating means converting into a company, okay? What is going to be the tax saving, if any, the tax and NIC savings for the current tax year? They've given you hints, not even hints, they've clearly told you what they expect you to do to answer this question. Okay, so kind of the examiner. So please make sure you follow that and don't do things your own way. The notes say that you are expected to calculate the income tax payable by Sarah, the class 1 NIC payable by Sarah, and the new limited company. Now, why are there two NICs? Because remember, when she converts into a company, there will be class 1 employee NIC, which is going to be paid by Sarah, the employee, and there'll also be class 1 employer NIC, which is going to be payable by her company. They also want you to compute the corporation tax liability for the new limited company for the year ended April 2026. The new limited company will not be entitled to the NIC annual employment allowance. Remember, we have an employment allowance of 10,500. So if the NICs payable by any business are within that limit, they don't pay any NIC, if you recall the rules. However, here they've told us that this is not going to be applicable for whatever reason. So don't follow the instructions, ignore that employment allowance. And lastly, you should assume that the rates of corporation tax remain unchanged. So going to our case, you should assume that today's date is 1st March 2025. Sarah is currently self-employed. If she continues to trade on a self-employed basis, her total income tax liability and NIC for the tax year 25-26 will be 11,034. So currently she's not she's not having a limited company, okay? She's working as a sole trader, self-employed person. And they're saying that if that continues, then her income tax as well as NIC will be 1134. And remember, what is our question asking us? That if she incorporates, meaning if she converts this business sole trader into a company, what will be the new tax and the new NIC payable by Sarah, the NIC payable by the company, and the corporation tax payable by the company? So those are what you're expected to calculate, and compare the two and see whether it's higher or lower. Now, they've told us, continuing reading the case, however, Sarah is considering incorporating her business on 6th April 2025. The forecast TTP of the new limited company for the year ended April 2026 will be £50,000 before taking into account any director's remuneration. Director's remuneration is an allowed deduction when computing the profits for the company. So they, of course, they've told us the forecast TTP is 50,000, but that's before director's remuneration. So that will further reduce by the amount of director's remuneration. And they've told us that Sarah will pay herself gross director's remuneration of £30,000, okay? So that means her TTP is going to fall by that amount. And dividends of £10,000. Dividends are not an allowable expense when computing the taxable profits for companies. So the 10,000 is not going to reduce the profit of the company. However, other thing that is going to reduce the company profits will be the class 1 employer NIC. Okay, so when the employer pays NICs on behalf of the employee, that is an allowable deduction when computing the profits of the company. So that's allowed. So those two things are going to reduce the corporation tax liability. So the balance of profits will remain undrawn within the new company. And that's it for the case. Let's start computing. So we follow what they've told us. You are expected to calculate the income tax payable by Sarah. We'll first compute that. We'll then compute the NICs and then the corporation tax. So Sarah's income tax liability for 25-26. Remember our pro forma. We've read the case. We know that she's going to get director's remuneration, which falls under non-savings income, and she's also going to get dividends, which is our dividend income. So remuneration, 30,000 is her remuneration, and then dividends are 10,000. So total income, which is the same as net income in this case, because there is no any deductions that we need to make. Total income and net income is 10,000. Okay, I'm going to adjust my decimal places there. Okay. Now at net income, remember what we said in class, always take a pause here and do your A&I calculation. How do you calculate your A&I? You're going to take your net income and adjust it for two things, which is our gross PPC and gross gift aid donations. But in this case, they are none. So our A&I is the same as the net income. And why is A&I important? Because that affects our personal allowance. If A&I is above 100,000, remember there is going to be a reduction to personal allowance. But in this case, we can see that net income is 40,000 and there's no adjustments for PPC or GAD. So Sarah is going to be entitled to the entire amount of personal allowance. So less personal allowance, we know that that is 12,570, and that is always subtracted from NSI first. That gives us her taxable income, 30,000 minus 12,570, and then her dividend income remains at 10,000. Now computing her income tax liability, starting with the NSI. Now, if you look at the total taxable income, 17,430 plus 10,000 is 27,430. So from this, you can establish that she is going to be a basic rate taxpayer. All of these are going to be taxed at the low rate because that's below, she's under the 37,700 band, isn't it? So NSI 17,430, you can in fact just self-reference it so that in case this figure changes, your NSI changes. So I'm going to put the equal sign and I'm going to click on the 17,430. The tax rate we know is 20%, and her tax liability therefore is going to be 17,430 times 20%. We then move on to taxing her dividend income. The total dividend income is 10,000, but remember that there is always the 500 pounds is covered by the nil rate band, so put it there. Although the tax is going to be 0, you need to do this so that the examiner knows that you know the rule of the dividend nil rate band, okay? And then let's adjust these figures. Hold on, I don't like the 2 zeros. To adjust to decimal places, go to the decimal, and then you can do a custom, put it on 0 decimal places. As you've seen, I put the decimal places to 0, okay? In your exam, you're supposed to always round off to the nearest pound. That is written in the instructions at the beginning of the exam. So now moving on, our dividends were 10,000. Out of that, 500 is nil rate band. So the remaining is 9,500. Again, if you can put a formula if you want, the 10,000 minus 500, so that in case your figures change, that automatically changes. Now, what's the basic rate for the dividend income? Let's say I've forgotten it and I would want to know what it is. As you see on the extreme left-hand side down, there is the tax table. So click on that. We know that there's a lot of information given in our tax tables, okay? So you can see the dividend rate, the basic rate for the dividend rates is 8.75%. So make use of the tax tables in case you're confused. 8.75%. That's going to be, if I simply pull down this, I don't even need to retype the formula. I can simply drag this down. Oh well, no, that didn't work. Okay, let's just type it. Okay, so that's going to be the tax on dividends. So that means the total, therefore, is going to be the total of all that we've taxed. So that gives us her total income tax liability as 4317. Now we move on to computing the class, the NICs. Okay, so there are going to be two NICs. There's going to be class 1 employee NIC Employee NIC, what are the rates? Again, this is given in the tax tables. But before we go to the rates, on what amount do we compute the class 1 employee NIC? It is always computed on the cash earnings, which is the salary, the remuneration, the bonuses, and the mileage allowances received over the statutory allowance. So what that means is that if you go up and look at her earnings, she's earning 30,000 from this company, okay? That's her salary, so that's her cash earning. Dividends are not considered when you're computing your when you're computing your national insurance rather. So ignore the dividends. It's only going to be on the 30,000. But if you look at your NIC rates, let's go to the NIC. If you go to the NICs, as you can see, class 1 employee NIC up to 12,570 is nil. So whatever is above 12,570 but below 5270 is at 8%. And we know that Sarah has the earnings of 30,000. So she's going to fall in the middle. 30,000 is whatever her earnings are above 12,570 is going to be at 8%. So let's do that. Is equal to take the 30,000 there in case that figure changes, you'll be on the safe side, minus the limit of 12,570. Okay, so whatever is above 12,570 is the one that you're going to pay NIC on. That's going to be at the rate of 8%. So the NIC class 1 employee NIC is that much, but again that's not rounded off to the right amount. So I'm going to go there, and if I could do the entire row, that would be good. The next NIC is going to be our class 1 employer NIC. Again, it's going to be computed on the same amount. So I can pick the 17,430 from there, but then the rate is different. Sorry, that's going to change. That's not, I can't use that amount because what's different for employers? Let's show you. If you see class 1 employer NIC, the first 5,000 you pay no NIC. Above 5,000 is at a flat rate of 15%. And there is employment allowance of 10,500, but they've clearly told us to ignore employment allowance, okay? So what are we going to do? We're going to take our 30,000, subtract 5,000, which is the limit for employers, and multiply that by a flat rate of 15%. So that times 15% is going to give us 3,750 as the employer NIC. So we've already done, let's take you to the requirement. We've calculated the income tax payable by Sarah. We've calculated the NIC payable by Sarah and the new limited company. What are we left with now? We're left with the corporation tax liability of the new company. So let's work on that now. Put a heading there. Corporation tax liability of the new company. If you don't have time, don't write this, okay? So that's just being organized. But again, exam technique, if you are slow or if you don't have time, don't write such a long thing. You can just write corporation tax liability. So we were told that the trading profit is going to be 50,000. Trading profit was 50,000, but we agreed that this needs to be adjusted. Director's remuneration is an allowable deduction. So we subtract off the 30,000 from there. And then we also know that class 1 employer NICs are allowed. So you're going to pick that figure from there. I'm not going to put the negative sign, otherwise my workings are not going to be standard. So class 1 employer NIC, go and cell reference that figure. Okay. And that gives us the adjusted, the TTP, taxable total profits, is going to be the 50,000 minus 30 and minus 3,750. So her TTP is 16,250, not hers. The company's taxable total profits are 16,250. We know that this is a 1-year period and there are no associated companies, so there is no issue of adjusting the limits. But again, there is no issue of adjusting our upper limit and lower limit. Remember, those are adjusted for 2 factors, as I mentioned. So our lower limit is 50,000, and we can see that the TTP is 16,250. So way below the lower limit, the corporation tax rate is going to be 19%. So corporation tax at 19%, simply multiply, is equal to 16,250 times 19%. Okay, that gives us, again, let's round it off to the right decimal. 3088 as the corporation tax liability. So that's your part A done. Okay, no, wait, let's get the total, because they've asked us, what is the question asking us? Determine whether or not there will be an overall saving of tax and NIC if Sarah incorporates her business. So let's see the total tax and NIC if incorporated. How much is that going to be? The total of everything, the corporation tax plus the employer NIC plus employee NIC plus the total income tax liability that Sarah has to pay. So the total there, rounding off, I could do that for the whole column. Okay, that would be easier. But well, since we're on the last one, I've left it there. Total tax and NIC if incorporated is going to be 1259. Current total tax and NIC is 11034. Okay, as you've seen in the question, they've told us that's the amount. So extra tax and NIC if incorporated is going to be 12,000 minus 11,034. So there's not going to be a tax saving. In fact, it's going to be an extra tax that she has to pay. So that's the figure there. She's going to have to pay an extra of 1515 if she incorporates the business. So that's your part A there done. We have followed all that they've asked us to do. They clearly told us what they want us to calculate. Make sure you follow the instructions. So there is going to be no tax saving. In fact, there's going to be extra tax paid. Moving on to the next question. Advise Sarah as to why her proposed basis of extracting profits from the new limited company is not optimum for tax purposes, and suggest how the mix of directors' remuneration and dividends could therefore be improved. So we've clearly seen from our previous computation that she's going to have to pay more tax. So now they're telling us that advise her why this proposed basis of extracting profits. What's the proposed basis of extracting profits? She's going to take 30,000 as remuneration and she's going to take 10,000 as dividends. So they're saying, why is this not optimum for tax purpose? And suggest how the mix of these two things can therefore be improved. Now, remember that when Sarah is taking remuneration from the business, that remuneration she's going to be paying 2 NICs on that. She's going to be paying the class 1 employee NIC as we've seen, and on the same amount there's going to be a class 1 employer NIC as well. Okay, and that is what is increasing the tax, because there are 2 NICs that are being paid as a result of this director's remuneration. On the dividend, we did not calculate the NIC. So a good thing for her to do would be that instead of taking more as remuneration and less as dividends, she could reduce the director's remuneration. Instead of 30,000, she should make it 5,000. Why am I saying 5,000? Because look at the employer NIC. If you look at class 1 employer NIC up to £5,000, if the earnings are up to £5,000, there is no employer NIC on that. So if she takes a remuneration of up to £5,000, she'll not be paying class 1 employer NIC, and the remaining amount she can take it all as dividends. And remember, even the rate of tax for dividends is much less than the NSI. The basic rate tax for NSI is 20%, but for dividend income is 8.75%. Okay, so that way, if she changes those two things, there's going to be an overall saving. So let's see how to frame that answer. It's a 2-mark question. So the increase in the overall tax after incorporation is because there will be 2 NICs payable. Class 1 employee as well as Class 1 employer. Okay. Restricting to reduce the tax, the overall liability, the director's remuneration can be restricted to, and a higher amount of dividends can be taken. That's it. That's your 2 marks. Simple as that. Okay. So that's your first section C question done for 10 marks. Easy as that. Not difficult at all. Okay. Now let's move on to the next question. The next question is asking us, calculate Simon's taxable income for the tax year 25-26 for 13 marks. So this is now an income tax computation for individuals. So this scenario relates to 2 requirements, this one and the next one that we're going to see later on. On 6th April 2025, Simon commenced employment with Eco Limited on 1st January 2026, he commenced in partnership with ART, preparing accounts to 31st March. So at the start of the year, he commenced employment. So he was employed for the whole year, but then he also entered into a partnership from 1st January. And remember, our year ends on 5th April. Okay, so the partnership, whatever we're going to compute, keep in mind that we'll have to only do it for January, February, and March. The following information is available for the tax year 25-26. From employment, he's receiving a gross annual salary of 24,250. Throughout the tax year, ECO provided Simon with living accommodation. The company had purchased the property in 2012 for 89,000 and it was valued at 143,000 on 6th April 2025. Now, this is accommodation benefit. The first thing you establish is this job related or non-job related accommodation? They've told us that the living accommodation is not job related. That means that Simon will be taxed accommodation benefit. And remember, there are 2 things under accommodation benefit. There's the basic benefit and then there's the additional benefit if applicable. Basic will always be there if it's not job related, but additional benefit will only be if the value of the accommodation is above 75,000 pounds, okay, a fancy house, as we used to call it in class. So they've said that the company purchased the property in 2012 for 89,000. And it was valued at 143,000 on 6th April 2023. Remember the other rule, we can clearly see that both these figures are above 75,000 pounds. So that means that additional benefit is definitely applicable. But the question arises as to what figure should we take? Should we take cost, the original cost of 89,000, or should we take its market value? We said that once it has been more than 6 years between the time the accommodation was first provided to any employee and the date of purchase, then you do not consider cost. You instead use market value for computing your additional benefit. And this property was purchased in 2012 and it was given to the employees in 2025. So you can clearly see that's more than 6 years. So we're going to use the market value for computing the additional benefit, okay? And market value is 143,000. So then they told us the annual value of the property is 4,600. So this is going to be your basic benefit, okay, the 4,600. Since the accommodation was there for the whole year. If it was not there for the whole year, you would have to time apportion that. And if there was any employee contributions for the use of the accommodation, that would further reduce the taxable benefit. Then now, number 3 says that on 1st December 2025, Eco Limited provided Simon with an interest-free loan of 84,000, which he used to purchase a holiday cottage. So beneficial loans, remember we looked at the 2 methods, the average and the accurate. Generally, we use the average method, unless you're going to be told otherwise. So we're going to compute the taxable benefit and the beneficial loan as well. So let's get started by computing our employment income. No, let's first put a heading there. We are calculating Simon's taxable income for 25-26. Again, this is just being organized. If you do not have time, don't bother writing that, okay? So what is part of his taxable income? First of all, we know that he gets a salary for the whole year. He was employed for the whole year, so salary is going to be 24,250. I'm just picking it as is from note 1. Then note number 2 says that accommodation benefit. We have the basic benefit, which is going to be the annual value 46, and then we have the additional benefit. Additional benefit, remember, the formula is going to be the cost or the market value. We established that we use market value in this case, which is 143,000 minus the limit of 75,000 times the official rate of interest. If you've forgotten it, it's given to you in the tax tables. Go to your tax tables. Look at the official rate of interest, 3.75%. Okay. So that's the additional benefit. So the total accommodation benefit is going to be 46 plus 2550. And then finally, the beneficial, no. There's also, the property was furnished by Eco Limited at a cost of 9,400. So there's another benefit he's getting aside of the accommodation. He got the furniture which he uses, okay? So the usage benefit on furniture, remember that's going to be at 20% of the value. So is equal to 20%. Usage benefit is always 20% times the value of whatever assets were given. And in case there was any contribution for the usage, that would reduce the benefit. So 20% times 9,400, that's going to give us 1,880 on the furniture. And lastly, our beneficial loan. What's the formula for the average method? You get the loan outstanding, the average loan, which is loan at the start of the year plus the end of the year, divide by 2 to give you the average, and then multiply that by the official rate of interest. But we know that the amount provided was 84,000. But here, be careful. On what date was the loan provided? The 3.75, the official rate of interest, is interest for the whole year. That's annual interest, okay? But this loan was provided on 1st December 2025. So you cannot charge him interest for 12 months when he only had the loan from December to 6th April. So he's going to be charged interest for December, January, February, and March. Is it? So what's our formula going to be? 84,000 times the official rate of interest, which is 3.75%. But you have to apportion for the months he had it, okay? So 1st December to 31st March, ignore the 6 days, is 4 months out of 12. That gives us 1,050 as the taxable benefit for the loan. Is there anything else under the employment income? No, there is nothing else. So we can just total up his total employment income. Total employment income is 34,330. Then we move on to the partnership income. Let's read what's under the partnership. The partnership uses the cash basis, but it claims capital allowances on cars. The partnership's tax-adjusted trading profit for the 3-month period ended March 2026 is 29,700. But this figure is before taking into account capital allowances. The only item of plant and machinery owned by the partnership is a car which cost 25,000 on 1st Feb 2026. Okay. The car has CO2 emissions of 125 grams per kilometer. That means since this is above 50 grams, it's going to go to the special rate pool and we get allowances at the rate of 6%. It is used by art, and 40% of the mileage is for private journeys. Now, since there is private use here, it would not even go in the SRP. It would be given its own column for private use because it's private use by the owners, okay? Now, in this case, art seems to be the partner. They're saying that there is 40% private use. That means the amount of capital allowances that the business will be entitled to is only going to be 60%, only the portion relating to business use. So, we're going to have to calculate the capital allowance and that reduces the profit. Now, if we read further ahead, they said profits are shared at 40% to Simon and 60% to Art. This is after paying an annual salary of 6,000 to Art. Okay. Now, remember, if you read the start, the partnership commenced on Jan 2026. And our year is ending on 6th April. So consider till 31st March. January, February, March is the months we're going to consider for the partnership. That means our capital allowances, the WDA, is going to have to be time apportioned for 3 months. Okay, the 18%, the 6% is for a 12-month period. If there is a longer or shorter period, we need to adjust those percentages accordingly. Don't get confused by the 1st February date. The date an asset is purchased does not matter for capital allowance purposes. What matters is the period for which you're computing. And we know we're computing from January to March. So we can't do that working here. We're going to put their working one and we'll go on the side and do our working one, partnership income. They've told us what was the tax-adjusted trading profit. Was 29,700. From that, we have to subtract capital allowances. How are we going to do that? We know that 25,000 is eligible for allowances even if it goes into its own pool because it's a private use asset. The fact that it's 125 grams per kilometer means it will be getting WDAs at the rate of 6%. But 6% is an annual figure, so we have to multiply this for the months that the business ran in the current year, which is January, February, March. So times 3 out of 12. And lastly, there was private use, and we can only get capital allowances on the business use portion. So the business use portion is 60%. Please be careful, don't multiply by 40%. 40% is the private use portion. We don't get allowances on that. We are calculating the portion on which we get allowances. So that's the 60%. And once you do that, that gives you 225 as the capital allowances. And then salaries. The salary also reduces the profits, okay? Art is getting a salary of 6,000, but this is an annual salary. This year, this tax year, is only for 3 months. So the salary amount is going to be adjusted for that. So multiply 6,000 times 3 out of 12 gives us 1,500. So the adjusted profits is going to be our 29,700 minus the capital allowance minus the salary. Adjusted profit is 27,975. From this, Simon's share we are told that Simon gets 40%. So 40% times, cell reference it, pick that figure, okay? So 11,190 is Simon's share. I can now come to my pro forma here, is equal to, and I cell reference that figure. Lastly, there's property income. Let's read what's under the property income. Simon owns a freehold house which is let out furnished. The property was let out throughout the year at a monthly rent of 660. Okay. During the year, during the tax year 25-26, Simon paid council tax of 1320 in respect of the property. That's an allowable expense when computing property income. He also replaced the property's washing machine during the year. Replacement furniture relief, you do get it, provided that you're replacing with the same kind of asset. If you replace it with something fancier, they will only allow you the cost that you would incur if a similar kind of asset was got, not a fancy asset. And in case you got any money selling off the old asset, any scrap proceeds, that reduces the benefit. So let's see, let's read ahead. He replaced the washing machine. The old washing machine was sold for £75. So there was scrap of 70 pounds. And he replaced it with a washer dryer costing 970. So he only had a washing machine. He's now replaced it with a washing machine and a dryer. So he's got a fancier upgrade, okay? The cost of a similar washing machine would have been 730. Are they going to allow us the 970? No, they are only going to allow us the cost of the similar washing machine. So they'll only allow us 730. But even from this, because we got 70 pounds from disposing the old asset, we will have to reduce the 730 by the 70 pounds. So let's compute his property income. We'll call that working 2 and then go do it on the side. Working 2, property income. The rent is, monthly rent is 660. He had it for the whole year, so 660 times 12. That's his rent, less the council tax was 1320. And then replacement furniture relief, that's going to be 730 minus the 70. So 660 is what is going to be allowed. So the total income is going to be the rent he received minus the council tax minus how much he paid on the replacement furniture. And there you have your property income. So go back to your main pro forma and pick that figure, cell reference it. Okay, so now that's it. Yes, so let's get his total income. Is going to be his property income plus his partnership income plus, of course, his employment income. So 51,460 is his total income, but they've asked us for what? Taxable income. Taxable income is always after subtracting your personal allowances. Less personal allowance. This is clearly below the 100,000 limit, so he's entitled to the entire personal allowance. That gives us taxable income of 51,460 minus 12,570. 38,890 is the taxable income, and that's your 13 marks right there. Not difficult at all. Okay, moving on to part B. Part B says that state the date by which Simon needs to notify the HMRC of his new property and self-employment income, and state by when Simon's income tax liability is payable for the tax year 25-26. So this is basically part of the self-assessment chapter. If you recall, dates Annoying to remember, but easy, free marks. It's just simple memory work, okay? So remember, taxpayers have a duty to notify the HMRC unless they receive a notice of liability from the taxman themselves. What's the date by which a taxpayer needs to notify of their chargeability to income tax? We said it's always the 5th October following the end of the tax year. So this is the tax year 25-26, which ends on 6th April 2026. So the 5th October following that date is 5th October 2026. So part I, 5th October 2026. And then part 2, when is Simon's income tax liability payable? Unless they told you that this is a paper he's going to submit physically, unless you're told that, remember the regular date is 31st January following the end of the tax year. So 31st January, the tax year ends on 6th April 2026. So the 31st January following that is going to be 31st Jan 2027. And those are your 2 marks right there. And that's your 15-mark income tax question done. We then now move on to our last question, which is the corporation tax question. Okay, so we are on the case of Naive Limited. Prepare a revised version of Naive Limited's corporation tax computation for the year ended 31st March 2026. Your calculations should commence with the profit before tax figure of 274,530, and you should indicate by the use of a zero any items in the computation of the trading profit for which no adjustment is required. Okay, so don't just ignore things that you don't need to adjust, because if you ignore, the examiner will think that you don't know the rule. By putting the zero there, you are showing the examiner that you know the rule, that that item is not supposed to be adjusted. Okay, so that instruction is usually there, and make sure you follow it. So, coming to our case, you are a trainee accountant and your manager has asked you to correct a corporation tax computation which has been prepared by the managing director of Naive Limited. The corporation tax computation is for the year ended 31st March 2026 and contains a significant number of errors. So as you can see, they've computed the tax. There's trading profits, and we've been referred to working for that. There's loan interest received, and then they've computed the tax. Now, if you look at the trading profits, they've started with profit before tax. They've adjusted for many things. Depreciation has been added, donations to political parties, QCDs, and so on and so forth. And then they've given us the final trading profit. So we're supposed to correct this. We're supposed to adjust this for things that are not allowed, or a different amount is supposed to go. We'll see that as we do the computation, as we add item by item. Okay. And then if you look at capital allowances, they've referred us to working 3. So we'll look at working 3 in a bit. Down on working 2, we have loan interest received. There's loan interest receivable of 32,800 for the year, and then they've told us interest accrued at 1st April 2025 and interest accrued at 31st March 2026. So this managing director, whoever he was, he added the interest accrued at 1st April 2025. He subtracted the interest accrued at 31st March. Remember that for companies, their incomes are on an accruals basis. So regardless of whether we receive the cash or not, what we were supposed to receive for the year is what is supposed to go as taxable income for the year. So loan interest received, this director, he actually calculated the amount that they received, the cash that he received, but it's not supposed to be on a cash basis. It's supposed to be on an accruals basis. So the amount that should have gone for loan interest would be as simple as taking the 32,800, the loan interest receivable. Okay. Then they said the loan was for non-trading purposes. Why is that important? Because if the loan is for trading purposes, then it does not go in the loan interest income. It goes in the computation of your trading profits. Okay, any loans related for trading purposes go in the trading profit calculation. But we are clear that it's not for trading, so that's fine. Working 3 is on capital allowances. Let's see what they've done. There are 3 things there: main pool, there's the car, and the special rate pool, and of course you have your allowances column. The tax written down value brought forward is 12,400 in the main pool, and SRP is at 14,500. They've done additions. There are 3 things: machinery, 42,300 has been added in the main pool, car 1 in the main pool, and car 2 in the depooled pool for the car, as you can see. Annual investment allowance is 68,500. Now, if you notice, this man or woman, whoever is, the director is very naive indeed, as the name of the company goes. Okay, they have computed they've given annual investment allowance on everything, including the tax written down value brought forward. So 68,500 is the total of 12,400, 42,300, and 13,800. All those things, this man has said that is eligible for AIA. First of all, the brought forward values are not eligible for AIA. It is only on additions that you make during the year, okay, and not all the additions. Cars don't go for AIA. Cars, if they meet certain criteria, they have FYA. Otherwise, they directly go to the pool. So only machinery, 42,300, was eligible for the AIA. We're going to have to correct that. Then we can see that there was a disposal in the special rate pool, but we know this man has been making mistakes, so we'll need to read on that. Then they've given written down allowances. If you see, he's given written down allowance at 18% for the car, and he's put times 50%. For what? We don't know. Maybe there is private use. Let's go see. Okay, that's the reason why it would be depooled. Now let's read the notes. Note number 1 says that car 1 has CO2 emissions of 50 grams per kilometer. So up to 50 grams per kilometer, if cars have emissions of up to 50 grams, they go in the main pool. So this guy, he was right to put it in the main pool, but cars are not eligible for AIA, like I told you. Car 2 has CO2 emissions of 105 grams per kilometer. So over 50 grams, they go in the special rate pool. But then they said this car is used by the sales manager and 50% of the mileage is for private journeys. There is private use, but in the context of capital allowances, private use is only considered if used privately by the owner. Okay? That this is private use by employee. So employee private use does not make it private use. This is a company, and the employees using the cars for private use is not considered private use for capital allowance purposes. So it was not supposed to go in a separate pool. It was not meant to be depooled. It was supposed to be put in the special rate pool. Then they said that all of the items included in the SRP at 1st April 2025 were sold for £8,200 during the year ended 31st March 2026. So the entire pool was sold out. They told us that the original cost of these items was £16,200. That's important. Why? Because the disposal proceeds can never exceed the cost. In case that's the situation, you have to restrict the disposal proceeds to the cost. Remember that rule? Okay. But here we're okay because the DP is 8,200 and cost is 16,200. So the amount that we can subtract from the pool as disposal proceeds will be the 8,200. So that's fine. But since the entire pool has been disposed of, there may either be a balancing allowance or a balancing charge. If it's a balancing charge, it will be charged all in the current year. But remember that if it's a balancing allowance, this is not a depooled item, okay? This is the special rate pool we're talking about. So if there is a balancing allowance, and because they've not told us that this business is shutting down, it's not the last year of the business, balancing allowances will not be given all at once. Balancing allowance is when the taxman has given you less allowances than he should have. And the opposite is balancing charge, where he's given you more allowances than he should have. So if he's given you more, he'll take back the more that he's given you. If he's given you less, he will give you the allowances, but the thing is, he'll not give you balancing allowances all at once. He'll give you the allowances gradually, depending on which pool we're talking about, gradually at the rate of 6% or 18%. Provided that this is not a depooled item, provided that this is not the last year of the business. In those two cases, you would get balancing allowance all in the current year. But in this case, in case it's a balancing allowance, remember that not all of it is going to be gotten in the current year. Okay, so keeping that in mind, we'll have to recompute the entire capital allowances. For loans, it's easy. We'll just have to take the figure of 32,800, and of course, we're going to have to make adjustments to our trading profit. So let's first put the pro forma as is, and we'll do workings for the figure. So Naive Limited. Oh no, I'm on number 60. Let me scroll up. Naive Limited, corporation tax liability for the year ended 31st March 2026. Oh wow, look at me typing 36. Sorry, 2026. Okay. So I'm putting there GBP. Sometimes students struggle to find the currency symbol. Otherwise, it's just here. Okay, format as currency, and then find the pound symbol. Where is it? Okay, not seeing it right now. So anyways, yeah, don't waste time there. We can directly go. Moving on. Trading profit. We are going to also have a working for that. We're not taking that figure. Loan interest receivable. It's on an accruals basis. So that figure we know was supposed to be how much? Let's go to the loan interest receivable was 32,800. Regardless of whether the cash was received, this man took the amount received only, okay? But it's supposed to be a total amount receivable. And then that should give you your total when you add up those two, and then you have corporation tax liability. At what percentage? We'll see later on. But for now, let's go to our working one. Working one is trading profits. Profit before tax was 274,530. Okay. Depreciation. The regular accounting depreciation that a business computes is not allowed, okay? Why? Because the taxman has his own way of computing depreciation, which is the capital allowances. So capital allowances are allowed. Depreciation is not an allowable deduction. So it was right for him to have added back the accounting depreciation. So add that back, that's fine. Donations to political parties. Are they allowed? No. They are not an allowed expense. So it was right for him to add back the 400. Okay. Then QCD. QCD was added back here. Was he right to do that? Yes, he was right to do that, because QCDs, this is not the place. You don't subtract them from when computing your profit before tax. QCDs are subtracted in your main pro forma for the corporation tax liability computation. After you get your total of all the incomes, from that you subtract the QCDs. So here, yes, you're going to add them back, but then we will subtract them from our main pro forma, okay? So to remember that, we can in fact subtract less, put there the total, less QCDs, 900 is the figure, okay? That means we'll need one more row here. Okay, that's fine. It's not coming for now. Okay, moving on, the QCDs, then there's accountancy fees. Accountancy fees are allowed. Okay, so this guy subtracted, he added back 2,300. Why did he add back? Because he believed that accountancy fees are not an allowable deduction when computing the taxable profits, but they're allowed, okay? That's for business purpose. So he didn't need to do any adjustment to that, and they said that indicate with the use of a zero where there's no adjustment. So put your zero there. Then legal fees in connection with the use of loan notes, and the loan was used to finance the company's trading activities. So that's okay. That's a business expense, okay? That's an allowed expense. No adjustment to that. It should not have been added back. Entertaining suppliers. Entertaining suppliers. This is third-party entertainment. Third-party entertainment is not allowed. So zero. Add back all the 3,600. Okay. However, entertaining entertaining employees is an allowed deduction. Third parties are not allowed. Suppliers, customers, entertaining them is not an allowed deduction, but entertaining your employees is an allowed deduction. Then they said gifts to customers, which were pens costing £40 each and displaying Naib Limited's name. We said if you're gifting your customers, as long as it is not food, drinks, vouchers, or tobacco, it's allowed, provided that it is within £50 per gift and it displays the company logo or branding. So basically the gifts should be for advertising purposes of the business, and there's a limit on the amount. Okay, now they've told us the pens were costing £40 each, so that's below our limit, and they had displayed the company's name. That's fine. So the gifts to customers worth £920 would be allowed. So gifts which were pens, that's allowed. The cost of that does not need to be added back. Oh, I said entertaining employees is an allowed expense, isn't it? So that should have been a 0 as well. Sorry, that's 0 there. Then gifts to customers which are food hampers. Now, even if you just stop there, food hampers are not allowed. We don't need to bother about the cost, regardless of the fact that they're below £50 and they have the company name. Food is not allowed. So gifts, which is food hampers, that's not an allowed deduction. That means we're going to increase our taxable profits by that amount. And then we finally have our capital allowances, for which we're going to have to do a working. So working 2. Okay, and then we will get the total trading profit. Profit is going to be the sum of everything there. When we fix the capital allowances figure, it will automatically include that. So now let's go to our working 2 and compute capital allowances. We established that there is no private use, so they can't be the column for the car. So we have our main pool, we have our special rate pool, and we have our allowances column. So tax written down value brought forward. For the main pool, it was 12,400. For the special rate pool, it was 14,500. They were additions of machinery and the 2 cars. So additions. Machinery is a main pool item, but it qualifies for the annual investment allowance. So put the value of the machinery, 42,300, and then tell the examiner that this is what is qualifying for AIA. And the moment you do that, go and put that figure in the allowances column so you don't forget. Okay, then car 1. Let's read about car 1. Car 1 has CO2 emissions of 50 grams per kilometer. So main pool item, car 1, 13,800 into our main pool. Then car 2. Car 2 has CO2 emissions of 105,000. And we established that private use by employees is not considered private use. So this is a special rate pool item. Since the grams per kilometer are above 50, the cost of car 2 was 14,000. So that goes in special pool. Then there is the disposal proceeds. All items included in the SRP were disposed of for 8,200, and that's less than the original cost. So we remove 8,200 from the pool. When you do that, the total there in the main pool is going to be that much. And the total in the special rate pool is going to be that plus that minus that. So you can see whenever the tax written down value plus the additions, when that amount is greater than the disposal proceeds. So remember they said the entire pool was sold off. So that means the taxman considered your assets in the special rate pool to be worth that much, the total of 14,500 and 14,000. But whenever you sold your assets, whoever you sold them to, they only considered their value to be 8,200. That means he's given you less depreciation, less capital allowances than he should have. So you're entitled to a balancing allowance in this case. So and we agreed that since the business is not shutting down this year, the balancing allowances are going to be given gradually at the rate of, this is a special rate pool item, so they're going to be given at the rate of 6%, isn't it? So we've got our totals now. We then need to simply calculate the written down allowance for the year. Main pool gets written down allowance at the rate of 18%. So 26,200, cell reference that and multiply that by 18%. That gives you 4716 in the main pool. And in the special rate pool, you're going to get the total times 6%. So that's your value. So the total allowances are going to be 4716 plus 1218. That gives you 5934. And so the final total for your allowances is going to be that much. Okay. Now pick that figure. That's your total allowances. Go back to your working where we did the trading profit. Capital allowances. Put the equal sign there and pick that figure. 48,234. So that gives you the revised trading profit of 345,054. So the capital allowances is not an addition. Okay, so we're going to have to change the formula because I used sum. So I'm going to change that. I'll put sum till cell D20, and from there we will subtract D21 because capital allowances are subtracted. They reduce your taxable profits. So your taxable profit, okay, let's change the formula. Sum, let's redo that. From there, stop before capital allowances and then subtract. Okay, that gives us 248,586 as our trading profit. Go to your main pro forma and put that figure there. So pick that. So our total is going to be the trading profit plus the loan interest receivable. From that we subtract the corporation tax. From that we subtract the QCDs of 900. So what's our corporation tax liability going to be? Let's shift that down. Get a total there. Is equal to 281,386 minus QCDs gives us our total taxable profits at 280,486. Now is this, let's look at the company. Is this a full 1 year period? This was corporation tax for the year ended 31st March. Okay, so 12 months. And were there any associated companies? There were no associated companies. So our upper and lower limits are not adjusted for anything. So clearly this is above the upper limit of 250,000. That means this company is going to be paying corporation tax at the rate of 25%. So simply do that. If you forget your tax rates, remember you can always refer to your tax tables. So 25% times our total that we've computed, and that gives you the corporation tax liability as 70,122. Okay, so that's your 12 marker done right there. Now moving on to the next question. The next question says that the managing director of Naive Limited understands that the company will have to file its self-assessment corporation tax returns online, and the supporting accounts and tax computations will have to be filed using the inline extensive business reporting language, the XBRL. Okay, the managing director is concerned about how the company will be able to produce documents in this format. Explain the options available to Naive Limited regarding the production of accounts and tax computation in the XBRL format. Remember in class we said that there are 3 options. First of all, you can use the software provided by the HMRC, but that's mainly for small businesses, so you will need to check. The managing directors would need to check if that software would work for their business. If the software provided by the HMRC can't work for Naive Limited, they have the option to use softwares from third parties. Others in the market also have some softwares that can compute in the XBRL format. That's the second option. Otherwise, the last option that Naive Limited has is that it can use what we call a tagging service. Remember we said that there are people who can tag the accounts for you so that they are read by the computers in the tax language. So you can use an external tagging service as well. So they can use any of those 3 options. That's 3 marks you can see there. So option 1, use the software provided by HMRC to use softwares available from third parties. And lastly, option 3, use tagging services by third-party providers. So those are the 3 ways in which Naive Limited can produce their accounts in the XBRL format, okay? And that is your last question in section C done. Easy, 15 marks, not difficult at all, as long as you practice. Remember, practice is what gets you the perfection. Okay, so all the best, keep practicing, and make sure you ace the paper.